Hi, Chris. How are you doing?
I'm doing great. How are you?
I'm doing fine. I got too much work to do, and I'm getting ready for the University of Florida program next Wednesday, Thursday, Friday in Tampa, Florida.
Well,
And
that
my
sounds
word,
exciting.
it will be a lot of fun, and there's going to be lots of puppets that I can go play with at the Estate View table. Are
Well,
you?
that's awesome.
Yeah. Where did you go to school?
Well, I went to Duquesne University here in Pittsburgh. I got my master's in tax.
Oh,
So it was a long time ago.
oh. What'd you do your undergrad at?
Undergrad at Washington and Jefferson College, which is also in Pittsburgh, Pennsylvania, just about 30 minutes south in Washington, Pennsylvania. College was
Wow,
formed in 1781.
wow. That I
So
heard that was the first puppet government.
it probably still is a puppet government. Or wait, okay.
Okay. All right. Well, Alan's coming, so it's going to get boring now. But thanks for doing the show with him.
Well, thank you.
All right. Well, welcome everybody to the amazing Chris Rowe. I have learned so much in this series, and we're going to just keep doing this series, maybe another 100 sessions, because this guy's got so much knowledge, so many great stories, and a lot of diligence for his clients, which is so important. There's no substitute for hard work. And as we develop the estate view, people say, well, will this save me time? Will it make me money? It will, but that doesn't mean you shouldn't pay a lot of attention to your client's details and spend some time working through checklists, working through running numbers, working through making sure the client understands things. And that's what we're going to be able to concentrate on today. If you are a Florida CPA or a Florida lawyer, you get credit today whether you deserve it or not. There are no polling questions. Sorry to disappoint you. If you're from any other state, we'll help you by verifying your attendance, which may be good, or maybe they'll punish you for watching this video. I don't know. If you have a question, you can go to the inverted question panel. It's the upside down pyramid. I don't know why they do it that way. You can type in your question like Loretta did, saying, where will I get my certificate? And Brittany will answer that Monday morning by sending you your certificate. We'll be posting this to the YouTube channel, and soon there will be an Estate View YouTube channel, but you can see Chris's prior performances, which are amazing, especially when he sings opera and dances ballet. He's killer good, and you can see those if you just Google Chris Rowe, R-O-E, YouTube Gassman, it'll come up and you can watch his previous things. If you're interested in Estate View, it's absolutely free till April 1st and almost worth that much, maybe more. Put the words, and go ahead and do this now if you want to follow us. A lot of you will. Go to your browser, not your search box, but the browser at the top. Usually that's where it is. And type in Estate View, ESTATEVIEW.link. And then it'll come up and you'll just hit the blue button there that says log in. Now, if you're up north, that doesn't mean put a log in the fire. That means log in. But if it asks you for your email address, test@test.com. If it asks you for your password, TEST. If it asks you if you're single, then you're probably on the wrong website. So don't do that. You'll get in trouble with your spouse, and you'll get me in trouble with my spouse. So we have these previous parts that you can go. And Chris, do you want me to give you control, or you want to just watch my screen
Oh,
for a moment?
I have some opening comments, so why don't we start there?
Okay, great.
Okay. So the seminar was titled, managing and the math around estate planning concept, or what we call wealth structures for clients. And I think as we start out, there's really two types of clients. Most of the clients that we all serve have less than $5 million. It's just a mere fact, right? That 98% of the world has less than $5 million. But we always talk about on these webinars sort of clients who have a lot more. And so I want to sort of set the stage here by doing this. There are two things that motivate clients to do planning or not do planning. And those are generally fear and greed, right? That clients have fear They don't want to do anything because they, for some reason, have fear that their heirs will, they don't deserve the money, they can't handle it, or whatever, or they have fear they're going to run out of money. Well, what if I need it back? Right? I want to control everything. And then other ones have greed. They want to give everything away, give it out away. I don't want to pay the government a dime. And then what happens is they end up like the first person who doesn't have any money left because things don't go their way. So I believe there's really a happy medium to doing the planning, right? And over the past week or so, I listened to a couple Morgan Housel podcasts. If everybody on this call should read The Psychology of Money. I think it's an excellent book by Morgan Housel. No plug. I don't get royalties if you buy his book. But I think it's an excellent book. And here's two what I consider big takeaways. That when we earn money, or our clients earn money, we buy things with it. Period. That's all we can do with money is buy something. And we either buy one of two things. We buy stuff, cars, houses, clothes, trips, or we buy investments or security or freedom or satisfaction, right? We're buying something. Money in and of itself is just money. It's what we buy with it. And it could be security, freedom, the ability to do what we want. It could also mean consumption, houses, cars. What's the difference? Well, his second point was, does your money control you, or your stuff control you, or do you control it? So in other words, when we spend our money to buy big houses, cars, etc., sometimes those things control us. They define who we are. Our shoes, our clothes, our watches, all that stuff defines who we are. And let's be realistic. As we all work, we all want the nice houses, cars, etc. I equate that, a lot of that, to back when we were kids. And when we were kids, when you played sports and you won, you got this nice trophy. Well, no one gives you a trophy when you're 52 years old in estate planning. Who gives you a trophy when you do a perfect trust for a client? Nobody. But they pay you, right? So we go out and buy a fancy car and go, hey, look at our trophy. Effectively, we're buying our own trophies, right? And a lot of times we'll let those trophies control us. And I think, why is this the intro? I think it's very, very important when you're doing estate planning, when you're talking to clients about moving money and saving taxes, really to kind of set the stage between fear and greed, right? And the clients, what's really interesting is they allow this money, this what they perceive as security, to control them. But in essence, their family's going to get it anyways. Right? So do it now and give your family a little more, or wait because you have this perceived, security, and your family gets it anyways. Maybe in a way that you really didn't want. And maybe the outcomes by you doing nothing are far worse. I believe that when we're making decisions, doing nothing is a decision. It is. It's a simple decision. I made the decision to do nothing. We know it's rarely the right decision, right? You're better off making a decision and doing it wrong and fixing it than you are by doing nothing, because nothing's probably not going to get you anywhere. And Alan, I'm going to just repeat in my opening what you said last week, and I'm going to butcher it. I'm sure I'm not going to paraphrase it perfectly, but as you said, complex problems come from complex solutions. Rarely is the simple thing the answer, right? In certain things, simple things can be answers, but rarely is doing nothing or taking the simple route. And for a lot of people, the simple route is doing nothing. That's their simple solution. I just won't do anything. I'm fine. I got all this money. Well, that's fine, but eventually you get to the point where you can't do anything. And generally, and I'll end with this, in my 30-year career, I'll tell you where these fear, greed, and everything play out. It plays out in life insurance. And let me explain what I mean by that. I will say that life insurance is predominantly sold, not bought. Not too many people go, hey, I want to buy life insurance, right? Most of the people will duck if they hear the word life insurance, like think it's something bad. But why it really plays out in life insurance is when you explain to a client why they may want some life insurance, they will generally, poo-poo you. We got this premium. I don't want to pay it, etc. And then every once in a while, you'll get a call. Hey, I know you were talking about that life insurance. How much can we get? And at that point, you know exactly what happened, right? That they had a health event and now they want to buy life insurance. And you're like, sorry, man, you can't get it now. Like, you can't do that, right? You had your shot and then you missed it. So for a lot of planning opportunities, some clients don't want to take it, but when they do want to take it, it's just too late, right? And it's going back to fear and greed and their emotions and how they deal with money. So let's move past that. But I think really everything we talk about has, and when you're managing, we manage all this stuff, Alan. And you do great work for a few of my clients, and we got a lot of structures that we manage. But I'll tell you what we're really managing. You're managing the psychology of the client. Period. End of story. We're not managing any of this. I don't care. I could show you portfolios that have higher rates of return and blah blah blah. Everybody on this call, and again, not giving investment advice whatsoever, right? Past results are future results, et cetera, all the applicable disclosures. But it's very simple. If you want to make a high return in investing, potentially make a high return investing, you buy stocks. I mean, go back and look at the last 200 years. The question is, most people can't handle the ride. It's like a roller coaster, right? And what happens is, I always use this example with a client. Hey, you've all ridden a roller coaster, right? And they go, yes. And I go, great. What happens if mid roller coaster you don't like the ride, so you decide to jump off? And they're like, what are you, crazy? You'll get hurt. Same way with stocks, right? If you decide that you want to buy stocks, which are a roller coaster, why are they a roller coaster? Anything that makes you more money has to be a roller coaster. No one's going to pay for things. No one's going to give you a premium for things that don't go up and down in value. CDs don't garner premiums. Equities garner premiums. There is no substitute for owning equities if you want to make more money. But fear and greed, right? You have to go back to fear and greed and say, you can't be fearful when your portfolio is down 30%. Right? You can't have it both ways. You can't be up 30 and be happy, and then when you're down 30, go, I'm out of here. It's not the work. So all of those kind of things, it's really the psychology of the client that allows us to do, whether it's estate planning and investment planning. And what I wanted to cover today, that was a little longer intro, is some techniques that we think about with respect to clients. And I want to meld not only the technique from an estate planning or an income tax planning standpoint, but also a discussion on, okay, each one of these things have different tax attributes to it, whether it be a state income tax, state income tax. So what do we put in it, right? We always sort of use a general scenario of saying, oh, you stick 3 million of assets. Well, that's fine, but is it my house? Is it 3 million in my car? Is it stocks, bonds, cash? What goes in those vehicles? Because there's one thing, there's the vehicle itself and what it can do, but then there's the next thing on how do we enhance it? How do we make it better for the client, right? And I use this term, and it's out there. The investment industry talks about alpha, this alpha, right? And it's a sort of standard term. What does that really mean? That means the amount of return you get that is better than the risk you're taking for getting the return. That's the simple definition of alpha. Okay. Well, it's been long proven that alpha in the investment industry is very difficult to get, right? There are a few people who can do it. We'll call them superstars, right? Those aren't the Warren Buffetts of the world aren't the standard bearers, right? They're the superstars. They're the lucky ones. The other people who could do it are mostly traders. It's their job, it's their profession. Like, Alan, you're an estate attorney. You're very good at it. Well, they're very good at trading. Why? Because their livelihood depends on it. But they're not going to give their secrets to you. That's their livelihood, right? We don't give all of our secrets up to the profession. If we find something good, we use it. So alpha is very difficult, but planning in tax, I call it tax alpha. Sometimes it's free. It's just sitting right in front of us. But in most cases, it relates to deferral. Delay, and when we talk about what we do with our money, delayed gratification. That's the word, right? You cannot contribute to a cash balance savings plan. If you're a sole proprietor making $1 million, maybe you could put away an extra couple $100,000 at the highest tax rate. Well, you can't do it if you're, if you're spending $1.2 million, right? So it has to be a delayed gratification. And as you know, Alan, most tax strategies involve delay, defer, right? You're not avoiding, you're delaying or deferring. And if you delay and defer long enough, you make up the money. Number one. Number two, sometimes you avoid, i.e. some other taxpayer pays the tax at a lower rate. But there's very few times when you can say, hey, I get to keep all of my money in my pocket, do whatever I want with it and not pay tax. That's nirvana. It doesn't exist. Maybe in the Cayman Islands, but they get you some other way down there. Right? So let's move on. That's kind of my intro, and hopefully you picked up a few things. So let's talk about, and I want to, Alan, if you could transfer the screen to me, because I want to use a state view.
Joe, how do I transfer the screen? Sorry about that. Joe's coming to our rescue. Where do I go to change presenter? I could have learned this earlier.
I think he has it.
Oh, you want to click change presenter? There you go. I click there.
Yes.
Okay.
And yes.
All right, there you go. Sorry for that.
Okay, I'm going to move this back. So I think, Alan, you had a slide up there, and I want to go back to a real concept that we talked about, which is risk that families face. And I think anytime we try to perpetuate wealth, we either grow wealth or move it to the next generation. And wealth is, obviously in the eye of the beholder. But families face numerous risks. And what we're trying to do is manage their psychology to help them mitigate the risk. You can't eliminate risk. None of us can. And I think what we do, the very important thing is that clients try to get the word guarantees, right? They don't want to do anything when you come up with this list of things that may happen. But they have to understand, and all of us have to understand, we live in an uncertain world. I think the most important thing about that last point, the uncertain world, I always hear from clients when we talk about owning stocks, oh, what if they lose me money? What if they go to zero? What if I lose all my money? And I go, well, if you own 10,000 stocks around the world through index funds and they go to zero, let's think about that. The last thing you need is money. Last thing we all need is money. We got bigger problems than money. Right? And by the way, I don't know how many people own stocks. I think it's 58-ish% of Americans. I thought I heard that, so forgive me if I'm off. But a lot of people are in the same boat, right? It's kind of like, we're on the Titanic. There was 1,200 people and it started to sink. I'm not the only person that's sinking. I got 1,200 friends that are trying to figure the same thing out. So point is, you got a lot of friends. But let's kind of go through and talk about a client. I'm going to set up a scenario where a client says, it's classic, I got $6-8 million, me and my wife, and I don't want to do anything because I want to make sure that I control everything and I can live on it, my wife can live on it, and we never ever run out of money. Then my kids will get whatever. Well, in that particular case, you don't have any estate tax, but what you do have is you could have some income taxes, right? You can have income tax, you could have You can have state inheritance tax in Pennsylvania. It's 4.5%. So on $6-7 million, it's 300-400 grand. What's the cost of doing nothing? Maybe it costs you 300. But what if you considered something like this? And so what I did was I said, okay, well, what if we get into our handy dandy private annuity calculator and say, okay, look, clients, and I'm just kind of using a simple, straightforward plan. Let's go. If you hit the Swift plan here, it just gives you a quick little snapshot, allows you to put things in very quickly. Interest rate, the age of the two grantors, the spouses. Do I want to have a 1 life or 2 lives over this private annuity? And how long do I want to defer the payment? And then how much of it do I want to sell? So I'm going to put 3 million in on a private annuity, and I'm going to hit standard mode so we could see this. What I did was right here, I deferred their payment for 5 years. Now, let's assume they're still working, they have a little business, whatever. They don't need the money, so we defer the payment. Now all of a sudden, I started to do a payment out all the way out till they're 93. And you can see based on, if you go over here, you could pick your growth rate, you could pick the estate tax, you could pick your deferral periods and years, and I assume wife dies at 95. Well, you can see here, they pretty much got back all of their money. So what's the worst that happens here? They got back all their money. The wife lived to 95 and she basically got back all the money. So you'd say, well, that really didn't do anything for you. Well, maybe not, but let's go over to and look at, what if we did a family limited partnership? And again, our discounted value is about 3 million. So we basically sold a family limited partnership interest for 3 million for a private annuity. Right now, we took some discounts here, and what this calculator shows is we basically have $7.5 million of an entity. Let's say they're worth about 7.5 million liquid assets, and we basically sold 60% of the interest, so they retained 40, or about 3 million, and we basically sold the rest for about 3 million. So what we did was we basically got about $1.5 million out of their estate. Or say, call it in PA inheritance tax, maybe 60, 80, 100 grand. But effectively what they've done is they control their whole 7.5 million. Okay? 40% of it is theirs. 60% of it, well, let's say it went to a trust for the benefit of wife in the future. So basically they control the whole assets and save them, 60, 80,000. Now I'm pretty conservative on, I was pretty conservative on discounts. I'm pretty conservative on earnings rates, and the chances are they'll outpace and save even more money. But when I look at this is a very simple structure where the clients could just basically control their funds, but set them up to save some, state inheritance tax in the future. Now, Alan, I'm gonna bring you in because I want to ask this question here. And this is something that I thought about. And let's assume that of the client's 7.5 million of assets, that they had 1 million or 2 million of assets that are very low basis. And so we make this sale, but we do a private annuity sale to a non-grantor trust, right? And maybe we sell that concentrated stock in the partnership, although we're selling partnership interests. We're going to sell the stock after we make that private annuity transaction. Does that, in essence, create a gain deferral? So in other words, it may allow a person to diversify concentrated assets because they feel they're going to live 20 or 30 more years and they don't want to take the risk, while we're getting some benefit of the gain deferral. What's your thoughts on that?
Well, I hadn't thought about it. So in other words, I have a shopping center that's got a basis of 1 million and it's worth 5 million.
Mm-hmm.
I sell it to the trust for basically 3.5 million because of this discount. And instead of paying capital gains tax at the time of the transfer, I pay it gradually as I get my annuity payments. Now I'm
Right.
causing some ordinary income in each annuity payment I receive,
Right.
getting principal back, and now the trust sells that shopping center for $5 million. It's got a $3.5 million basis. It only pays capital gains tax on $1.5 million. So yeah, you preserved. If you take no discount, you have deferred that capital gains tax.
Right.
I think
Now
you're
the
right. Now, you have the anti-rushing rule if you do it with an installment sale within 2 years. But I got to ask Jerry Hatch. So the anti-rushing rule doesn't apply to a annuity sale. That's
well
really
that yes, the anti-rushing rule applies to the installment sale, but it may apply to an annuity sale. That's not where I was necessarily taking this conversation. But my question is, and this may be a question for Jerry. So number one, this used to be called the sale to the non-grantor trust. Everybody would do it like 5 minutes before the closing, and you would defer the gain, right? The IRS said, or Congress said, we don't like that. We want it, if you sell to a related party, a trust, your kids, and you have to wait 2 years before you sell the asset. So the question is, using your shopping mall, for example, when you sell, if you sell the shopping mall, and let's assume it's inside a partnership, if you sell the shopping mall but retain the cash in the partnership, is that considered selling the same asset? I.e., I transferred partnership interest, I didn't transfer the mall. Number one, does that also apply to things such as concentrated stock? I sold the stock of IBM, I didn't sell my partnership interest, and the entity still owns plenty of other assets. So that's an interesting point, but the whole point of this discussion is you could also always wait the 2 years, right? If you knew that, hey, I own this shopping mall and I'm probably gonna sell it in the next 3 to 5 years. I'm 65, 70 years old. I don't want to deal with it anymore. I'm probably gonna liquidate it. I'm not gonna hold around till I get a step up in basis. You could position yourself using whether it be a private annuity or an installment sale, and I was gonna go there next, to potentially defer the income tax, right? You defer the income tax. Now, again, with an installment sale, you don't get a step up in basis on death when you have that installment note in your estate. But it just is what it is, right? You're going to sell the place anyways. You're going to record a gain. Why not give 20 or 30% to the IRS? Why not just kick the can down the road?
so. Let me mention a couple things. First of all,
Sure, go ahead.
I think you want to check the box for non-voting there next to your cursor, just to show that it's
Oh,
60
sorry.
non-voting. That doesn't change the numbers, by the way. It just shows the people that it's non-voting. Secondly, the IRS says when you make a sale for a private annuity, you've got the probability of exhaustion test, which is shown on that calculator. So if you don't have enough assets in the annuity to support the sale under the probability of exhaustion test,
I'm going to go back.
you may have made a large gift. Yeah, if you click on standard or advanced, it's on the far right. There's that exhaustion test. So the trust has to have $5 million worth of assets separate and apart from the private annuity.
Right.
But that, according to Larry Katzenstein, who's my hero and the creator of Tiger Tables, that regulation may not be valid. Plus, I don't think you really care what the IRS thinks if you're at 5 million. It would just be a matter of what the state people think. So just wanted to mention that. I also want to mention this can be very complicated. So please don't base your planning on what we say today.
Correct.
Or someone equivalently smart. But these are really good ideas.
And again, I think in the end, one of the things that I've found over my career is you vet some of these, and as you vet them, I think this was your opening, Alan, right? Will this save me time and make it easy? Well, number one, time savings comes with learning, and number two, easy. There's probably nothing worth doing that's easy, right? If it's really easy, it's really not worth doing. So you have to spend a lot of time thinking and what I'd say going down rabbit holes. And the goal of any strategy when I come up with it is really to disprove it, right? Tell me why this doesn't work.
Yeah, let me also mention that you could give grandma and grandpa general powers of appointment
Yes,
over the
sir.
shopping center to get a full step up when they die. And that's a reason that quite a few of our clients are putting assets in slats and irrevocable trusts to give older relatives powers of appointment. It makes the funeral much less sad if you've gotten a step up at the time that these loved ones pass away. Or should they put the shopping center in a Florida community or Alaska community property trust and get a full step up on the death of the first dying spouse? So you have to just weigh all that stuff. Or should they have done a 1031 exchange first? Do they understand how that works as they factor all of this stuff in? But certainly a number of families have this private annuity sale to a non-grantor trust that, quite frankly, 98% of advisors have probably never offered to their client.
Well, I think you said it best. You just said it best, right? There's numerous strategies, not all. I think when you're doing planning, whether it be income or estate tax, it's not always a one size fits all, right? And it's sometimes a combination of things, just because of the psychology of the client and what some of the end goals are.
Now, while we're on the private annuity, you know, there's this new CCA issued by the IRS, which says that if you want to give the grantor of the trust the ability to get repaid for his taxes because it's a grantor trust, that's a gift from the kids.
Right.
So people don't realize, though, you take a 70-year-old here and he has some assets that he transfers to the trust in exchange for a private annuity. So in other words, he's like, I don't want to pay these taxes anymore. Give me a reimbursement clause. Well, no, the IRS doesn't like reimbursement clauses, but if you'll give $3 million to the trust, then you'll start getting $380,000 a year in 5 years for the rest of your life, which will more than repay the taxes.
Correct.
So a lot of people are out there with these trusts that they set up, and the solution is not necessarily to ask for a reimbursement power. Honestly, I don't like reimbursement powers at all myself, but this is just a good solution. And Jerry's always concerned that people are going to make a big gift to a trust, and then they don't realize the burn, which you see there in red on the spreadsheet. Every year, the client's got to pay some income tax. Well,
Right.
the solution may be to sell assets to that trust in exchange for a self-canceling installment note with high interest rate,
Right.
or the private annuity. So just wanted to throw that in there for people who are concerned about that new CCA.
Right. I think those are all good strategies and things that we all need to consider for our clients. Going back to my initial comment of tax alpha, right? Sometimes these strategies really save clients money, and clients focus on investments a lot. But in reality, there's more money to be made in planning than in investing, because it's very difficult to create that extra return over a certain benchmark in the investment world. Some other things, which is just outside of really estate planning, but as we're talking about doing some income tax planning, and we have businesses for clients, and I know you had mentioned this on other webinars, Alan, but back in 2018, there was a section 199A came in, which gave a deduction for what they call qualified business income. And without going into all those details, if you're basically running a business, there's a complex calculation, but you get basically 20% of the net income as a deduction. And what it effectively does for taxpayers in the 37% bracket, it basically taxes the business income at around 29 to 30%. So, however, there's calculations, limits, like anything else the government gives, and then they make it complex to figure out. But so some of the things are really of doing some income tax planning, and a lot of times for clients who are 5, 10, 15, 20, even 20 million, income tax planning becomes much bigger than estate planning. but we use certain techniques that really apply to estate planning to do the income tax planning. So for instance, you know, whenever we're making gifts or business income, if you're running up against certain limits on the 199A, or you're in a high tax bracket on capital gains, you may obviously look to shift those income to lower tax brackets. Kids, grandchildren, some of them may be in much lower brackets that you could shift. And we use that as a technique that sometimes you call bucket planning, right? We look at everybody's bucket. Think of the tax rates, and each, you know, you start out at 0, 10, and you go up. We look at those as buckets, and you're looking at your family and you're trying to move things around in buckets. And Alan, I believe one of your past presentations, you bring up this concept, and you may want to expand on it.
No, I think you said it. You said it very well. And you know, a lot of clients are kinetic thinkers, or they're visual thinkers. So if they're visual thinkers or kinetic thinkers, anything you can do that draws a picture is going to help them.
Right. And
By the way, Chris, before I forget, would you just click generate explanation there,
absolutely.
and then click the PowerPoint
Uh,
presentation, and then click submit. So now we can send this PowerPoint to everybody who's watching. And then would you click export to Excel to there, so we can send the Excel spreadsheet to everybody? The export to Excel is at the bottom there.
Oh, I hear.
Yeah, right there. Okay, so now you've got the PowerPoint that explains the planning, and you've got the Excel spreadsheet, which we can send to the participants. I just wanted to make sure we got
And
that.
I'm gonna move this over so that people can see what the PowerPoint generates. So it gives you a nice little picture. It gives you the advantages. Another pictures so you could show the clients. Got some caveats. What are the risks? What's the estate planning side of the annuity? Who the grantor is, etc. So what this does, and you want to know about simplicity and saving time, developing the strategy. I mean, I would argue, having done these from scratch, these things take hours. They take hours to develop these presentations, and rarely have I found where clients want to pay you hours for the presentation. So you as professionals say, well, if I prepare this presentation, hopefully I can do it numerous amounts of time and make up my cost. So I think that's super important. And I'm bringing up the Excel here for the output of the calculation to also be able to print that out in Excel and show the client.
Yeah, so we can send that to all the participants later so they can play with this on their own. Yeah. Okay.
Another little concept, and this is whether it be using this state view or not, but it's a concept that I've explored in the past that I think some clients could very well benefit from. So let's talk about dynasty trust, and whether you have 5 or 10 million, or whether you have, you know, 5 billion or 100 million. A lot of us really, when we set up trust, we're setting up dynasty trust, right? We don't know. We put 1 or 2 million in a trust. We're going to say, hey, look, put it for my grandkid, or put it for my kids when it goes to my grandkids. So one of the things that, as the IRS just put out, that they basically held that assets in a grantor trust don't get a step up in basis. You know, there's been a lot of disagreement in the industry on whether that happens, that doesn't happen, et cetera. But let's assume, I'm an optimistic person, but I'm also the position that probably when you do that trust, you don't get a step up. Okay. So if you're doing a dynasty, let me take a step back there. Alan had some good points. So how do you achieve step ups and those types of things? Well, giving grandparents general powers of appointment, giving the parents a general power of appointment, especially when they don't have any estate issues. They're not going to be subject to estate tax. We know they're not. There's some other things to consider with those power of appointment, and I'll come back to that. But The other thing that I think when you're doing a major gift, and we can come up with a large lifetime gift, you say, okay, I'm doing that, but now I'm putting 8, 10, 5 million in this trust, and it's going to grow for 20 or 30 years. How do I avoid the income tax? Okay, it's a grantor trust. Okay, I can pay it, but again, going back to what we call the burn, I don't really want the burn. Well, a concept that I thought about was, could you take a life insurance policy, right? A general variable life insurance policy, and when you make the gift, you then take some of the money, doesn't need to be all of it, but some of the money, and you put it in a life insurance policy. Now, the life insurance policy is really designed to give you minimum death benefit, the absolute minimum death benefit I need in order to qualify this thing as a life insurance, which means you put a large amount of cash with minimum death benefit. Yes, it becomes what they call a modified endowment contract. That's a fancy word for, if you ever take money out, it's going to be treated like an annuity from an income tax standpoint. But you put that in there and you let it run for 20 or 30 years, invested in the cheapest index funds the policy provides. And what's interesting is I did an illustration, and basically each year, if you look at an internal rate of return to the person setting up the policy, usually it's generally you would find the person who is the youngest and the cheapest we can find from the internal life insurance cost, right? Younger, cheaper, and healthier. You basically lose each year about 11% of the return. Call it tax and drag and cost. Well, if you illustrate this at 7%, I illustrated one for a 35-year-old kid to their life expectancy, and their rate of return after all costs, fees, et cetera, is 6.2. And if you think about it, it's 11% drag every year, Alan. But you could basically, you kind of pay an 11% drag, but you could basically rebalance the policy as you see fit. You could trade it, you could rebalance on the inside, and there's no tax. There's, I think that's a tremendous opportunity. And then what happens when the person who's the insured passes?
No tax.
You get your step up in basis, right? You effectively get your step up in basis.
Chris, I don't understand the math. I put $1 million. I put $1 million in a very low cost, low death benefit modified endowment contract life policy.
Mm-hmm.
It grows at 7%. So the first year it's worth $1,070,000, and the drag is only 11% of the 70,000.
Well, no. So when you look at it as a rate of return, so if you put in, let's just say you put in $1 million, and I'm not sure what the death benefit may be. Let's say it's $1.1 million, right? Right. So if you put in $1 million, you die in the first year, you get $1.1 million. Okay, you made a gain. But your cash value of that policy, right? Here's the negative, and I think the question you ask is really the negative to the client. Okay, when you put $1 million, your first year cash value, even if you grew it at 7%, isn't $1,070,000. It might be $800,000.
Right.
And the client says, "Well, look, this sucks. I don't understand. I lost $200,000. Yes, you did, client. If you surrender it in the first year, you lost $200,000. The point is, going back to the initial fear and greed, these structures work when clients understand them and they realize that there is, they need to hold it for 20 years, right? We're doing this structure not because we want to get the money back. We're doing it because you put this money for your grandkids, okay? And your grandkids are not even born or two. And you have, a 30-year window. So yes, at first, when you actually look at the cash value, Alan, it's negative, right? You've put in more than you get. But as you go out 20 or 30 years towards life expectancy, right? What happens is when you look at when you look at the return on death benefit, and I think this is a little side note, I think most people, when they look at life insurance, they look at it from the death benefit and what I need it for estate planning, et cetera. But it also, you have to look at it as a return on death benefit. That's really what it's an investment. I don't care what you say, it's an investment. Term insurance is not. That's a
Okay,
cost.
but I still don't understand the 11% drag.
Okay.
What's the math on the 11% drag?
So when you put your money in, right, and you run the illustration out, and you're looking at what the cash value is, okay, and then you say, okay, well, what happens when I die and my kids get the death benefit? When you compare the amount of premium you paid, so on year one, let's use the $1 million. I put $1 million in. 30 years later, I get X out, right? Whatever it is. When you look at the two of those, your net return, your IRR, between what you put in and what you get back as the death benefit, assuming the policy's internal performance was about 7%, it ends up being 6.2. It's hard to see these things without an illustration, and,
Yeah.
and it's really a concept, Alan, and someday I'll show you that illustration. But what you have to realize is the takeaway of this is that insurance policy, the IRS, or sorry, not the IRS, but Congress has given individuals two big tax planning tools. And those tax planning tools are called annuities and insurance. And they are, and I will say this, and people can yell at me, they are abused by our industry. They are. They're misused, missold, etc. But that doesn't mean that if used properly, they can't provide a massive tax benefit to clients. Right?
Yeah, let me also mention, if you have 10 million or 100 million, then you can do a private placement life policy.
That's correct.
With very low cost and almost term equivalent death benefit. And then if you want to be aggressive but legal, whatever that means, you can use a you can use a special feature, sometimes known as the Hamilton freeze, where you don't need the death benefit mortality cost after a certain period of time because you freeze the cash value. So those just sing and dance. They sing and they dance. They're quite wonderful. And one thing I had our law students look at was how much money congressmen and senators receive from the life insurance industry, and that helps to explain what it is and why that loophole probably will stay open a while.
Right. And I'll mention this on private life. So sometimes we'll call it private life insurance versus, I don't know, a commercially available life insurance. What sometimes has a tendency to happen is that, in my experience in talking with the industry, sometimes commercially available life insurance is actually slightly more cost effective. Sometimes.
Yeah.
And the reason is there's so many more people looking at it. I mean, you got thousands and thousands of people who are looking at these policies, so they have a tendency to be sort of, we'll call it market price. On a private life insurance case, they have a tendency to be slightly more expensive. Okay, that doesn't make them bad. Just understand. Why are they more expensive? What I always say is anytime there's a tax benefit to be had, someone wants a piece of your tax savings. The person setting it up, the industry, et cetera. But private life insurance works well for families who want to invest in things that a traditional off-the-shelf life insurance policy can't do. In other words, if I bought a traditional life insurance policy from a big carrier and it's a variable, I'm going to be limited to what I can invest in, index funds, markets, etc. Private, I could do things such as hedge funds, separate account managers, private equity, those things that are really tax inefficient. And I think this moves us into the next sort of phase, as I was discussing, is how do we how do we deal with these various structures? So we have grantor trust, non-grantor trust, life insurance, retirement accounts, personal tax accounts. And what you're doing is you're looking at a family's entire picture of assets, shopping malls, publicly traded stocks and bonds, hedge funds, private equity, et cetera. And you could be developing and using these structures. For instance, if you have a fairly wealthy client, and fairly wealthy doesn't mean 100 million, could be 20, 30 million, and they want to put 2 or 3 million in hedge funds, private equity, et cetera, a private placement life insurance may be the best place to own it. And maybe owning that inside of a dynasty trust may be great. Thus, you can put all of your, you can get it outside their estate. You can put all your, what I call ordinary income tax or the worst income tax assets into a wrapper that defers it. And it allows you to trigger the tax when you want to. Again, what do I own in my own name? Well, tendency that I own in my own name, things like stocks, low dividend paying stocks, things that are going to grow, things that allow me to pay capital gains tax at 23.8 versus ordinary income at 40% when I need to trigger the money. So understand what assets, what are the tax attributes of those assets, and then try to help clients draw a picture of saying, okay, if we own stocks in your personal account, we own some taxable bonds over here in your IRAs, we own some hedge and private equity and really tax inefficient assets over in your private placement life insurance or a non-grantor trust or a trust for your kids through a partnership so that we have a lower tax rate. All of those things really help the client. And there's what I call no risk per se, right? We're just putting things in the right buckets that have a better tax result. So Alan, any comments on that, or how have you seen your clients doing the tax planning and how do you work through that for them?
No, it's just so wonderful when a client has an advisor like you or a very, very bright CPA who walks through this or brings somebody in to
Right.
to bring that creative team in. And that's why we call Jerry Hesh so often, because I tell the client, you know, I know what I would do, but I don't know what I don't know. So
Right.
calling people in can help. By the way, would you mind just showing the life insurance estimator for
Oh,
1 minute
absolutely.
so people know it's there, because it's a pretty good resource. And again, this is all free at least through April 1st.
So let's assume if you look at the life insurance estimator, you have Mary, she's a female. Let's assume she's 65. Okay. And you know, you have $1 million. Let's say we want 3 million on her. Excuse me. It gives you a sense of what a 10-year term would be at preferred and standard. A 20-year term would be at preferred and standard. And then it also shows you what a universal life policy or a permanent policy would be at preferred and standard. Most people ask, well, I don't understand, these permanent policies cost so much more than term. Well, yes, because they're designed to pay. The rule of term is about 2 to 3% of all term policies actually pay out, right? So that's why they're priced, you know, a third less, where generally when you buy a permanent policy, they're going to pay you. Now they have lapses and people forget to pay and things happen, but that's generally, you're paying more. Why? Because you're going to get a return.
Right. And the only reason we put this feature in Estate View is because whenever I do estate plans for clients, I'm calling insurance agents saying, how much will it cost? How much will it cost? I want to know before the client walks in the door. It's only a guess, but at least when the client says, well, how much will 5 million of coverage cost me? At
Right.
least I can say, well, if you're standard, then it might cost you X dollars. So at least now they have an idea. They'll say, yeah, I'll buy that. If it's cost that much, I understand my family needs it, I'll buy it.
Right.
So at least I get a sense of direction out of them.
And I'll give you a little tip, and I think I said this last week. In years of talking to clients about life insurance, one would say to give the lower number, i.e. preferred, Why? Because maybe more likelihood that they would say yes when you know they need it. But I've learned over the years to really quote the standard and say, look, it may be better, or you may get better underwriting, but this is where sort of an average person of your age and health sits. And that way, because what happens is if you quote them 21 and then it comes back at 30, they go, what? 30? You said 21. Clients always remember the lower number.
Yeah.
So, good. So let's, we have about 5 or 6 minutes, left. We talked about where do we own assets. Alan, in the 5 or 6 minutes we have left, any specific points you want to make as we move forward?
Well, I think for the viewers, if you're thinking about buckets, an important bucket would be the charitable remainder unit trust. Because even if the client is not charitable, would you rather pay tax the year of a sale, or would you rather pay tax over 20 years ratably, where you get 90% or more of the assets back? And the 10% in 20 years can go to a donor advised fund or a private charity managed by your family. So when clients hear about that, and it used to be, I think I will say the standard of practice because of the case law was you could literally do this a week before a sale, when the client was darn sure the sale was going to happen. But now you've got to do it probably 5 weeks before the sale's really hammered out. Unfortunately, I don't agree with what the tax court did with that last year. But if you're not showing clients charitable remainder unit trusts for their appreciated stock, then you may get criticized later. You got to hit reload when that happens, and then it reopens right to where you were. So I'll have to get Kevin to fix that if it's not working. Kevin's working on some stuff today, so he might have dislodged it. So,
well, I think this is an important point, Alan, that you said, and I had this exact example with a person who worked for a public company, owns a large amount of publicly traded stock. I mean, represents 40 to 50% of his overall wealth. He hasn't worked there. The company is going to be acquired. There's an announcement, but again, they have a lot of regulatory hurdles they still have to get through to get the approval. And he wanted to sell his stock. He is charitably inclined and he wants to divest some of it. And I had brought up the charitable remainder trust, right? And some of his other advisors would say, hey, well, how about doing an exchange fund? How about doing this? And I go, well, yes, how about maybe doing them all? Right? There's no one size fits all, right? Depending on what the goals we're trying to achieve, there could be multiple strategies. But I would say and I'm giving this perspective from advising clients and the feedback I get from the client. The client goes, okay, well, and what's the risk? And I said, well, the risk is even if you did, joint life payout, or I guess you could do a 20-year term for your kids, but what's the risk? The risk is if more money goes to charity and less money goes to you guys, and maybe you didn't want that, your kids don't have as much net worth, right, that you thought. That's the risk. Maybe more goes to charity.
Yeah.
How do you hedge the risk? Buy a little life insurance. I mean, I hate to say it's almost like I talked about life insurance the whole time today, but not that I'm a life insurance sales guy, but sometimes it works. Like, buy a little life insurance. You're getting a big payment. You're deferring the tax for 20 years. You were willing to give 23.8. You add another 3% in PA, almost 27% to the government. You're ready to just pay the tax and give them to the government. Take a little piece of that tax and buy a hedge. Effectively, whatever it is, it's called a hedge. You're buying a hedge is what you're doing. And you're buying downside protection in case something goes remotely wrong that you weren't planning on. And I think that's really the point as we wrap up here in the last 2 minutes, is sometimes when you're looking at strategies, investing, whatever, for wealthy families, right? you want to be, it's usually time is your friend. The longer you wait, things have a tendency to work out. But number two, you always need to put in the hedges when you need it. Do you want me to?
Yeah, I took back control.
Okay, good.
And one of the things, by the way, if you want to be a great presenter, you finish on time, and that's what Chris does. But what we're going to do is, for no continuing education credit beyond the hour, but a lot of you want to see more about Estate View. A lot of you don't, of course, but most of you, by our experience, do. So I'm going to play a little bit with Estate View when Chris is done, and I hope Chris will stick around with.
I'm going to stick around and
any questions, let me know. But Chris, go ahead and close. Sorry, I interrupted you. Go ahead and close up.
well, I'll close with this. Could you hit news, Alan?
Yeah.
And I hope it's still up.
Yeah, the new the AICPA member.
Nah, I must have.
No. Okay.
No, I didn't see it, but right before we got on, I was looking for a news feed, and sorry, I may have been switching around, so we're not going to try to find it. But it asked that there was a headline that says, "Is the financial advice you receive on TikTok good?" And it says one economist says yes. And the answer is, I guess you can always find someone to agree with that headline. But so I'll end with this. And I'll make my ending with this, and I go back to what you said, Alan. Rarely is complex problems resolved with easy solutions. And I know I didn't say that just the right way, but so rarely can you solve your problems with easy advice on TikTok, okay, or the internet. Usually there's a lot more considerations one needs to put into whether it be our personal plans or plans for clients. And you said this a few minutes ago, and I was remiss, but I'll comment now. I firmly believe that there are some times when both ourselves and our clients, that sometimes having more people at the table results in less action, right? Sometimes having more people at the table causes more confusion, and this doesn't make decisions. But in the world of tax and estate planning and all of these complex issues, like you said, Alan, you called Jerry, we can't, there's too much for any one professional to know. I mean, there are a lot of professionals I know a lot, okay? But they're just too much. It's too many moving parts. And sometimes in the area of looking at tax planning, of financial planning, et cetera, having a team that works to vet issues for clients is very, very important. And I'll end with that. We don't work in silos. We all work together as a team for the end result being to have better outcomes for our clients. And if we ultimately have better outcomes for our clients, we have better outcomes for ourselves. And I am with that. Thank you.
All right. I was dying to say some things during your talk. So
Please,
I'll
go ahead.
What Bob Burke always said, and he was one of my mentors. Bob Burke he would sit down with the client. We'd have the big chart out that I would make up. And he would say, Clyde and Amy, for every complicated situation, there's a simple answer and a simple solution. And then he would pause and he would say, and it's always the wrong answer. Complicated problems call for complicated solutions. So if you want to save a lot of estate tax and a little bit of income tax here, you're going to have to put up with Alan and his darn charts and all his stupid documents. And, the clients would always get a chuckle out of that. Some of the things that I say in the conference room are, the predictability of making money on equities is unpredictable, but the predictability of inflation taking away your purchasing power if you stay in cash is completely predictable.
Yep.
And then I also say, if you really think that all the financial systems are going to break down, then should you have 5% in gold coins, which is insane and not anything that I would recommend, but it would be more insane to keep everything in cash. Yeah. And then some clients will go buy a bunch of gold coins, which I tell them is completely insane, but then that somehow gives them the psychology that they can get into equities. The other thing I do, which my mother taught me, my mother used to sell jewelry in a little jewelry store, and she said, they always buy what I wear. They always buy what I wear. So I have my pension plan history in my conference room, so I can show them this is the allocation that Marcia and I chose in 1999 with our fee for service planner, and it's still just about the same allocation. And the best thing the planner has ever done, which he does every 90 days, is tell us not to change it. And here you see these curves. You see every time it went down, it came back up within 6 years. And within 8 years, it always came back up way strong.
Right.
So, you know, saying those things, and then years later, clients come back to me and they say, I love the estate plan, I've loved the relationship, but the best thing you did for us was show us your pension plan allocation, because we did something very similar and we made sure we kept the cost down, and thank you, thank you, thank you. So just dying to say those things.
No, I think those are all I think those are very important points. And I think the most important point you said is there is as a professional, when we sit on the opposite side, not taking into account client psychology, there's this nirvana of what we would do, right? So like, oh, we could do all these things, scratch, crotch, struts, you know, everything with an acronym. Look, client pays 0 estate tax. But let's be realistic. Most clients aren't like, great, just do whatever you want. Let me know, you know, tell me where I need to move my assets. So, and it comes to investing, I think the goal is to, as a professional, to advise the clients to move them from where they are to where they need to be. And sometimes it's not nirvana. And as you said, if they are willing to invest 95% of their assets in stocks instead of cash, and all they need to do is buy 5% of gold bars, maybe for them that works.
Yeah. All right, I'm going to get back to estate view now. Okay, so on estate view, you go to news, and then you can choose to see the news or to see the summaries. And then you can pick a news feed. So if you want to see what's going on with the Journal of Accountancy, this updates every 30 minutes. So you can, and then beginning April 1st, if you go ahead and just enter into any questions about the software or estate tax planning or estate planning in general, someone from my law firm or Jerry Hesh or Jonathan Blockmacher or Bob Keebler will always be answering these during the day. So that's the news feature. I also wanted to show you, Chris, that we just added these valuation discount calculators, and they're nothing really complicated, but they're educational,
right?
Because it at least helps you explain to a client, look, Harry, your EBITDA is 400,000 a year, and based upon your situation, the valuation person says that maybe it's worth 6.5 times EBITDA. And then you've got $500,000 more of assets in the company than the company needs to operate. So that's an additional value. You've got debt of 300,000. You want to transfer 40%. It's non-voting. And we're going to assume a lack of control discount and a lack of marketability discount. We're going to have to hire the valuation person to write the report. It's not going to come out exactly at these numbers. You may also get what's called a tax affecting discount. And you may get a discount because you don't have an employment agreement with the company and you could leave at any time. And therefore, your stock, we think, rough estimate, is worth 689,000, discount 494,000. So then when you get the report, you can click on duplicate, and then you can plug in the actual numbers. Well, the valuation person came in at 7.1 times earnings and came in at 15% lack of control. And therefore, the discount is a little bit different than we thought. Now, Chris, what we just did for a client, and we did it for another client a couple of years ago, was we hired 2 valuation firms,
Hmm.
and under attorney-client privilege. And then guess which valuation opinion we use?
The lower of the two, Alan.
The lower. That's what Professor Miller taught me at the University of Florida in 1983, and it's saved a lot. But at least this way you can illustrate to the
Right.
client what the differences were in the report, and to a young professional or a new professional. I just thought it was neat, so we put that out. Now, Chris showed the
Is that
valuation.
a standard that you use? Do you normally hire 2 valuation firms, or do you do that when it's significantly large?
Significantly large, like $50 million or more.
Got it. Okay.
And by the way, there's nothing unethical about telling the valuation firm, I will pay you 70% of your fee when you give me a number within 5% of your final answer. And I'll pay 30% of your fee if I ask you to write up the report. So then I hire 2 separate valuation firms that they don't know about each other. And I get my numbers, talk to them about what the basis of the numbers are. I learn a lot from talking to both of them. It helps me maybe communicate to get a better result from the report as well. So we do that with real estate. We do that with business valuations. Not at all unusual. So those are 2 of the calculators. Then on the required minimum distribution calculator, and by the way, on all the calculators, let me just point this out. All the calculators work very similar to one another. It opens in, well, let me go to Cupert. So here's a qualified personal residence trust. It now opens in what we call Swift Plan, because a lot of people said, this is too complicated. Can you just do what the other programs do? I don't want anything more than what the other programs do, because I don't want any more complexity. So this on Swift Plan, which is going to sell for $199 a year, does generally what we use the other calculators for. I'm not saying that we do everything that the other calculators do, but we do most of those things. So, but what we do in addition to that for this low cost model is you can run multiple Cuperts. So here I can show the term of the Cupert being different, or the value of the property being different, and what the difference is on the gift. And then it also shows you what the annuity would be if they move out of the house, or they sell the house during the retention term. Then with every calculator, you can go to standard mode. When you click standard, you've got more columns across the top. The blue and the green are what you started with. Now you've got all these white columns across the top. You can change the columns you see by just clicking on boxes. And the yellow ones are the ones that we normally keep. And then you'll have fewer columns. You can hit fit width and see all the columns. And now in the more complicated version, it is showing you your estate tax savings. It is showing you, if you want, your capital gains tax that you're having to pay because you did a Cupert and you lived past the term and you died and didn't get a step up. And it illustrates the rent income and the burn. Now, when I'm in standard, when I page down to in the first Cupert, it's telling me here, if you want to do multiple Cuperts to get discounts or partial ownership discounts, and if you want to show rent after the Cupert term, you have to click on advanced. So I go back up, click on advanced, and now it shows me those things, and it opens up more rows. The spreadsheet, I can click on those 2 horizontal lines, and I can move the spreadsheet up. The pink is showing me my year of death. The yellow is showing me my estate tax savings. And this is, I guess I would call it in real time. For example, I'm on Cupert number 1 here. I can click on Cupid number 1, and what would it look like if it was a 2-life Cupid? Click there, the numbers change. And then for all of these, or at least today, the vast majority of these, I can click on general explanation, has nothing to do with the military. And then I could do PowerPoints for all 3 Cupids. I can do general explanations. Paul Hood is working to improve these today. We're going to talk about it this afternoon, Paul and I. And I can also click on PowerPoint presentation, put the client's name down there, and then hit submit. And then it shows up on the top right hand if you're using Google Chrome, and it's shooting all of those things forward. And then I can open them, and it shows all this data. It shows the client, here's what a Cupid is. Here's all the numbers that Alan has used on your Cupid. Here's the result, and here's the spreadsheet. So we definitely are continuing to improve this, but it is pretty neat to see. And it makes it very easy to teach young tax lawyers, I've learned, how to learn more about the tax law. So just more features. Now, let's say that I want to send this calculator to somebody who's not a subscriber so they can use it. So I clicked on Share with Client, then I click on Generate URL, click on Copy to Clipboard. Now I can copy and paste this into an email, and this HTTP address will show up, and I'll say, Clyde, go to this HTTP address, put in the code 688887, and you have 12 days to use this calculator with this client's name on it. So that's the share with client mode. If I want to take a picture and save my inputs, I can just click on the camera, and it now has a picture of my inputs that's convenient for me to use or show later. There's the picture it takes, so I can print that or use it later.
That's
I can
great.
I can take a picture here of the choice of the summaries, and I can also take a picture there, or I can save the Excel spreadsheet, and I've just done all that. And then when I click timelines and charts, Kevin has done a real nice job of giving us other cool things.
Oh.
So this is showing you for Cupid number 1, the chance of surviving the term, 88%, and the tax savings, about 50%. But if I increase the term, I'm going to have better tax savings, but lower chance of surviving the term. So that's one thing. Then probability of survival by age, property interest values, annual and total rent paid, and assets subject to estate tax. So all of the calculators are going to be a little bit different. And the most popular calculator, according to Bob Keebler, who's been helping me with the design, and I thank him sincerely for that, is going to be the large gift calculator. And what the large gift calculator does is I'm just going to give you, I'll just tell you my entries here. There's the exemption is going to drop by 50% in 2026. State tax rate 40%. We do not do state estate taxes, just federal at this point, but you might estimate 44% if you want to kind of back into what the state tax might do. Inflation 4%, the client is 70 years old. We're going to illustrate this out to age 97. They're spending $200,000 a year more than comes in, and they have a $4 million portability allowance. Their home is worth, let's say, $1 million with a 3% growth rate. Current investments, let's put at 21.5 million. Investments growing at 7%, but 2% of that is paid to Uncle Sam, and it's going to be a grantor trust. So we're never going to toggle off grantor trust status. Oops, look at the red. Under this scenario, it's telling me I'm going to run out of assets by age 100. Jerry Hesh made me put that in there. So, but I can see right off the bat that if I can toggle off grantor trust status at the right time, I won't have a problem, at least at the top. We're going to look more into that. My gift made, I like to show 1 million on the first gift. And then if I use a discount, I won't use a discount today, but you would in real life, no discount. And then the year one gift, $1 million. Are there crummy powers? Let's just say there's a couple. And then we're still working on the surviving spouse. Kevin has promised it yesterday, so I hope to get it today. It's about halfway there to show the surviving spouse's situation and a credit shelter trust and a Q-tip trust for the surviving spouse. But with those inputs, what I can show the client is across the top, I'm going to have $1,442,000 savings as the result of a $1 million gift. So the savings per million is 140 is $1,442,000. But once the client makes a larger gift and gets past the portability allowance and gets past the temporary exemption, then there's going to be a much better result per million. But if the client gives too much, they will run out at age 100. So I go to gift number 2 here, where they're making a 13 million gift, and I can simply scroll down and see I scroll down to a $12 million gift, and it's fine. It lasts at a $12 million gift. So, and you see with a $12 million gift, a better result, incremental per million. But what Kevin really did that knocked my socks off is I can go to timeline and I can go to gift number 2, which I'm looking at. And this shows me for every year from the time he makes the gift, what's in that gifting trust that receives the 12,610,000, which is there, what his residence is worth, which isn't much in the scheme of things, and what his remaining assets are worth, and what the estate tax is going to be each year that he dies. Because it's easy for me to say, yeah, at age 97, you won't have an estate tax, but this shows me the timeline. And now I can also say, well, Floyd, you want to give less? Let's see how that looks. If you give 9,600,000, you'll have a lot more, but there will be that estate tax. And then we'll see how toggling off can affect that. Because you have the ability to toggle off grantor trust status, you start here, but as you toggle off grantor trust status in each year, you'll have more assets. You won't run out of assets. You just may pay estate tax, but there's where you'll run off. So this is a really nice tool to tell a client, here's how much you can gift. And then you can also go back, I'll go back to gift number 1 here, and say, well, what if my spouse splits the gift? I can click there, and then it's not going to make a big difference in this person's situation on a $1 million gift, whether the spouse splits it or not. Now, Paul and I are working on the general explanation, the planner's checklist, and the PowerPoint presentation, but this still, I'm going to just print the PowerPoint presentation. It's not as good as it's going to be, but it is there. So if anybody wants it, I can send it to them. Chris, anything that you can think of that I've missed in what I've shown?
No, I think that's excellent. I guess maybe it's outside of what we're talking about, but how do you get the client to make a larger gift than maybe they're willing
Well,
to?
I think it's education, education, and education. One thing we're going to add to the large gift planner, hopefully by April 1st, is also what I call the private annuity sale rescue.
Right.
I was talking to Stacy Eastland about that. He goes, that's a good name. Call it the private annuity sale rescue. And you can show them, well, at age 80, if you run short, you can do a private annuity sale, and if the 75/20 rate is X, then you'll get plenty of payments if you want to trade back into the trust. Now, Stacy told me something about a contingent private annuity sale, where if you do a slat and your spouse dies, you automatically get a private annuity, which you pay for at the time you set up the trust. I don't know if any of you have ever heard of that.
Never heard of that. That's
That's
interesting.
feasible. If Jonathan and if my advisors, the creative team, Jonathan Blockmacher, Jerry Hesh, and Bob Keebler, if they all give me a thumbs up, I'll add it in. But if they don't give me a thumbs up, I'm not going to add it in.
Right.
So now I'm going to take you backstage. I'm going to go to staging. I'm not going to give you the password, but I can go to staging, estateview.link, and I want to show you some of the stuff we're working on. I think you've seen the Monte Carlo spreadsheet. So the Monte Carlo is going to enable us to show a client, if you're going to have the assets invested for X years, here's the 90th percentile on rate of return, the 50th percentile, and the 10th percentile. So at least the planner has something to show the client.
Right.
And I'm hoping to have this fairly soon, but it's definitely not going to be immediately. But that's going to be the Monte Carlo, and then we're going to be able to move that into the Nest retirement calculator, just so that planners can now see a range, so that and clients can better understand. And then the rolling grat, I'm going to admit to everybody, I was not a fan of rolling grats until I started running the numbers with the spreadsheet that we've developed. So here's our proprietary spreadsheet.
That's
And
excellent.
yeah, what we did was we ran the numbers from 2004 through 2024 to see what would have happened if you had invested just before the market tanked. And let me see where this went. I'll move down here, come back to the left. And every year, using these grats, we show how the darn money moves, which is crazy because every year the grat empties into the next grat, and then every other grat. It's like hopscotch. It's pretty cool to show it. And then we show the rate of return. But the pie here, the red is the assets still under estate tax, and the white is the part that avoids estate tax. And as you move this nice rascal to the right, in year 14, look how much you've removed from the estate tax system without using $1, or maybe only using $5,000 a year of your exemption.
Right.
Without any discounts. So I'm looking forward to when Kevin has that up and running as a calculator.
And I think that's excellent, Alan. The rolling grat strategy is excellent, and I've used that for clients. And normally we create grats for each asset class, right? We don't put them all together. You sort of break them up. Why? Because every asset class acts differently. Number one. Number two, I think it's hard to illustrate, but I've had this example where one asset went down. Let's say you put it in there and it's down 30%. And you look at that and go, well, this grat's never coming back, right? It's never going to work. So we buy the asset back out of there.
Yeah.
You buy that particular asset, you put in cash or bonds, you let the grat run its course, and the person gets it back, but yet you start your regrat early.
Yeah.
And I think your important point was you could do these by using very little exemption.
Yeah, and then we ran the numbers on Stacy Eastland's leverage grat, and my gosh, is that effective? I mean, if you would do a leverage grat as opposed to a regular grat, maybe there's a little risk there, but if you can be very conservative on your valuations and run some amazing numbers. Now, we improved the amortization calculator so it's less confusing. When you open it up, you choose, tell me the payment amount and I'll input the rest, or tell me the number of payments and I'll input the rest, or tell me the principal amount. I'm sorry. Yeah, I want to know the principal amount, so I'll tell you the rest. So it'll solve for any of these. And of course, it tells you the AFR. So that's up and running now. And it saves a lot of spreadsheeting for people. Almost up and running is, and hopefully by Monday or Tuesday up and running, is going to be the letter writer. And I can show you a little bit about what it's going to be like. You know, you meet with a client and you met with them and you call them Bob or Mr. Jones, Mary or Mrs. Jones, and then are there multiple clients or single? Is there business involvement with the children? Are there decision making with respect to the authority of a trustee? Are you addressing creditor protection? Are you addressing protection of an inheritance? Anyway, the list here, we have about 30 things, and then as you click on it, it appears in the letter. So what I normally tell a client about conflict of interest, if it's a married couple, I'm representing both of them, I click on that, that goes in the letter. If I'm only going to represent one spouse and I'm stressing that the other spouse should get legal counsel, I click on that, it shows in the letter. If I tell them about the crime fraud exception, if I help them with creditor protection, then I click on it, it shows up in the letter. So it gives me a checklist and it gives the client a nice letter. So like I said, I hope to have that next week. And then the life insurance policy organizer, the spreadsheet itself, I think is really nice. It allows me to put in a spreadsheet the spouse one's life insurance, spouse two's life insurance, and any second to die life insurance, which, as you know, just getting that information and organizing it is very valuable.
That's a task in and of itself, Alan.
Yeah, but then it reminds me, or it reminds my staff, for term life, get the convertibility deadline and put it in a spreadsheet and make sure the people know that they need to go renew that thing or get new insurance before their convertibility deadline runs. Make sure they know that these policy loans cost them more than they think that they do. They think that these policy loans are free. They're usually not free at all. Are you sending withdrawal powers if the policy is an annual premium payment? We'll also be showing the split dollar amounts to remind you that you could be doing split dollar. If it's not in an ILET, we're telling them, tell the client it should be in an ILET, or what the estate tax is. And then we can show, and this isn't going to be up and running for a while, what that rate of return is expected to be. You know, if you cash it in today versus if you die at whatever age we've selected, here's your rate of return. So the clients have a little bit of information there. So that's going to be, and then eventually this will generate a letter that at least explains it to get the client thinking about their life insurance.
Excellent.
Yeah, the next thing we have is, you know, I'm always telling clients, give me your census and I'll send it to an actuary to see if I can get you a better pension plan than what you're getting from your bank or your broker. Quite candidly, because the banks and brokerage firms aren't doing cash balance plans, and they're not doing defined benefit plans,
Right.
well as the better actuaries. So the census simply has inputs on the left of all the information you need for each employee to prepare the census. And then you can also, I had an HR person tell me what a typical small law firm would need to know to run their HR. You know, when's her anniversary date? Did she come up for a review? What's her bonus going to be? And then there's totals. How much are you spending on clerical? How much are you spending on paralegal? So that's going to be, I think, you know, a fun little tool.
And Alan, are you going to allow a client to input the census?
Yeah, I'm going to send them
A link.
I'm going to send them the link and say, open this up. It's yours for free for 12 days. Fill this out, and it'll automatically go on a spreadsheet, and then we'll send it to Matilda, the actuary, and see what we can do for you.
Excellent.
Because otherwise, you know, that's the reason for it.
Yeah.
And then finally, and this is something that, you know, for a lot of law firms will turn out to be the most valuable thing we have. And that is what our firm does. We use Google Sheets, but now we'll be able to use this software. And when we take on a client, we'll be able to input in, which we do now, the client's name, the intake day, whether we sent them the representation agreement, whether they signed it, did we get our retainer, How are we charging? Who referred them? Did we get their information? Who did we assign to make sure that I do my work on this file? What's the file matter? Does the billing department know? Have they set up a billing number? All this stuff from the beginning to the end, including, did you send out the first meeting letter? Did you set up the next appointment? Did you send out the draft documents? Did you call the client to make sure they got the draft documents? Did you schedule the next meeting? And then if you don't have any activity on this spreadsheet for a certain period of days, the row for that client will turn red so that you get a red alert. Hey, you haven't heard anything for 30 days. So this is going to help a lot of law firms. And Chris, I'm sure you can help me adapt this for financial planning firms as well, because you guys are going crazy trying to get us to do our jobs and reminding us, you're right. So,
Yeah.
Maybe at some time we'll have interacting
Right.
sheets, just
Well,
like
this
with,
is definitely creates efficiency. I mean,
yeah,
I
yeah,
need that myself.
yeah.
You,
Now,
you
Chris,
go
for
crazy
yeah,
memorizing it.
for married couples, I just want to let you know that we have added in the installment sale the ability to choose which client does the installment sale. So it can be a slat. So the grantor of the trust is spouse one or spouse two. Now we'll eventually have two installment sales, one for each spouse, but we did do that. I guess I lost Chris. I guess his wife probably said, Chris, that's enough. Come home. Marcia never says that. All right, so let me see if there's any questions. And I apologize for the shameless self-promotion, but I'm just very excited about this software, and it's been a lot of fun to prepare it. Okay, Samuel, any chance of getting first year free for longtime participants? You'll have to talk to Marcia about that. That's my polite way of saying no, sorry. Marcia wants me to get some small return on the hundreds of thousands of dollars that I've spent in time and money. How do I get to the news? Okay, how you get to the news, on the right-hand side, the button says news. And you click on the news button, and then you can choose your news feeds. If anybody is affiliated with an organization and you would like to be part of our news feed, let us know, and we'll be glad to consider putting you on the news feed. And eventually we could have more of these or other innovative uses of this particular feature. But for example, allowing you to choose the types of news that you want to get from the feeds. But as of today, we don't. So your detailed instruction manual is here under detailed instruction manual. And it has been written by a very bright Georgetown LLM student who's also a Purple Heart recipient. Jason is incredible. And although we keep changing the software, he's almost up with us in describing how every part of this works. The best way to learn how to use it, I think, is just to put it on your computer, play with it, then watch a video and make the changes yourself while you watch the video. But for those of you remaining, I wanted to just thank, I have not done this alone by any means, but a lot of help from Jerry Hesh in particular. Jerry has put a lot of time and effort into this software. He was working on a software program in the 1990s when I first met him, and I was very interested in it. This is becoming what he wanted. Bob Keebler, Jonathan Blottmacher, and Chris Rowe, thank you so much for everything you've done. And thank you for a
Thank
fantastic
you, Alan.
presentation today.
Thank you for having me. I really appreciate it.
Yeah, thanks to Bob Burke for inventing the Bob Burke's rule.
I use that now all the time. I stole it. Sorry.
Perfect, perfect. All right, everybody, have a fantastic afternoon and weekend. Thank you so much for sharing some time with us. Bye.
Thanks, you too. Bye-bye.